Hi, everybody. Welcome back to our YouTube channel, Fast CPA and Consultants. I'd like to introduce our CPA, Fulton Abraham Sanchez. Welcome, Fulton.
Hi, Sarah. How you doing?
If you're here for the first time, we have this series called Tax Talks, where you send us your questions through email, social media, and today's topic is when to choose a trust. Are we ready to begin?
Yes.
Okay. First question is, what is a trust?
A trust is an agreement that is established with the objective of protecting, the objective of transferring assets from a person or an individual to this entity that is formed, that is a trust. The basic objective of a trust is to protect or to say yes, to protect the assets that are received into the trust. So a trust is not a document that you have to file with the government or with the courts or with any government institution or office. The trust is a document, it's an agreement that is written before an attorney, and this agreement, once it's certified and notarized by the attorney, it's given life to an entity separate from the owner who is creating the trust. And once the trust is formed, the trust is ready to take over the assets from the owner or from the person who formed the trust. It's called the grantor because the grantor is the person is a grantor because it's going to grant the assets to the trust. So that is basically a trust.
Understood. Second question, what is the difference for asset protection between a trust and an offshore company?
The offshore company is an entity that still is an instrument to do business. The objective of offshore companies, as any company, is to make money, to get profits, to finally, the final result of the entity is profits. And this offshore entity is usually formed in an offshore jurisdiction like Cayman Islands, Nevis, Antigua, that is different from the United States and different from any other legislation that a person may have. These are offshore entities or offshore jurisdiction are very different from regular jurisdiction in Latin America, in Europe, or in the United States, or um, also in the Middle East. Now, the basic difference between that, the offshore entity that is created to make money, to produce income, to get money, and a trust is that the offshore entity still owns the assets and will pay taxes for those assets that is owned in the entity. And the protection that the offshore entity will provide is basically the secrecy of the assets that the entity, this offshore entity is going to receive. Because remember, you open an offshore entity with the objective of transferring your assets to that offshore entity. That's the first or the basics of an offshore entity. I open an offshore entity with the objective of transferring my assets to protect my assets with the offshore entity. I can also create an offshore entity to do business and produce income from the offshore entity, and not and that money, have that money far from my country. Could be far from the United States or from any other country in the world. So I will have it separate from the money that I have in my country of origin. That's the objective of basically the creation of an offshore entity. Is in addition of the asset protection, is also the separation of my financial assets or my property. Basically, it's a financial asset from the assets that I have in my country of origins. In my country, the government seize my assets, I have this portion that is in an offshore entity that will not be seized. That's basically the concept of an offshore entity. The offshore entity also protects the owner, the identity of the assets owner, because the owner will not, the company will not reveal in the public records who is the owner of that company, and that company therefore will be, the owner will be protected, and the asset that the company holds will be protected as well. That's different from a trust. The objective of the trust is more than the protection of the asset, is the conservation of the assets. So with an offshore entity, I protect my assets. With a trust, I conserve my assets. I preserve my assets. So why do I use a trust, or when do I use a trust? A trust, let's say that you use a trust when you have a generation after you, and you want that generation to receive the benefits or to receive the asset that you are going to transfer in that trust. So it's a different concept from an offshore company. The offshore company is created, it can receive assets, it can protect the asset, but it will not be usable, or the use of the offshore entity will not be good for transferring the asset to the next generation. The trust in exchange is the instrument of preference for transfer the assets to the trust, your assets to the trust. You discharge your responsibility for taxation for the income of those assets. The assets are placed in the trust, and you instruct to the trustee, that is another person different from you, or you can be as well the trustee. You instruct the trustee in the indenture, the document, when the trust is created, that the trust should be given to this person or to that person after you pass away, or after a certain amount of time. The trust can be revocable or irrevocable, and the trust can be created in the United States, it can be created in Europe, or it can be created also in an offshore entity. So as we have an offshore company, we can also have an offshore trust. But if you create an offshore trust and you are a US citizen or a European citizen, there are reporting obligations that we are going to cover in the next question. But this is basically the difference. With an offshore company, you protect your assets. With an offshore trust, or a trust in general, you preserve your assets for the next generation.
Understood. Next question. What are the types of trust that exist?
Depending of the use of the trust, there are, for example, trusts that allow you to grant the asset to the next generation, to give the asset to the next generation, if that's the objective of the trust. There are trusts, for example, that are created with the benefit of funding education for the next generation, for example. There are trusts that that receive the assets that you have, and they will, after you carefully instruct what is going how the asset will be distributed, the asset will be given to the person that you have. So this is a different type of trust. There are other trusts, for example, that are created for specific purposes. For example, you want to donate a certain part of your asset or your income to a specific foundation or a specific institution, and you instruct in the indenture, in the document of the trust, that that part of your assets should be given to X or Y foundation or X or Y nonprofit organization. So it depends of the objective. There are trusts for preservation of income. I'm sorry, preservation of the assets. There are trusts for donation, a trust that is giving away your assets to detail or specific institutions. There are also trusts that they are useful for finance and a specific objective. It could be the education from your grandchildren's, or any project that in the future might arise. For example, there are if we go for, we differentiate between offshore trust and domestic trust in the United States or in Europe. There are irrevocable trust and revocable trust in the United States. In outside of the US, let's say an offshore trust, they are usually done irrevocable. There are irrevocable trusts. There are also revocable trusts, but at the end, the objective of the trust for offshore trust is the giving of the asset to the next generations, or to preserve. I've seen trusts, for example, offshore trusts, that there are companies in Latin American countries. There are any type of company, and the assets or the shares of the company are given to the trust. So the owner is not anymore the person, a person. The trust is the owner of the assets. So when the shares of the company in any country are given to an offshore entity, the offshore entity, in this case the offshore trust, will be the one who will be the owner, and in addition will be the one who controls the company, and also will be able to dispose of the dividends that the trust is going to receive, because that is something else. When the assets are transferred to the trust, and this trust creates income, it could be a property, it could be a company. A property creates rent, company creates dividends or profits. The trust is the one that receives the profits, or the rents, or the income, and that is, now the trust is the owner of that. And depending on the legislation of the trust will pay taxes, or if it's an offshore trust, will not pay taxes, because there's no taxes in the offshore legislation of the offshore jurisdiction. But that is when the assets of the trust are transferred to the offshore, and when the assets of the title of the domestic company in any country are given to a trust in a foreign jurisdiction, like an offshore trust. So that is that is that's going to be the result. If the trust is formed in the United States, then things change a little, because here in the United States there are a lot of types of trust, and people create this trust for different purposes. The ones that I detailed before, to giving away the property to a new generation, to finance the education of the grandchildren, or to donate the trust to another, to a foundation or to a non-profit organization. Those are the main types of trust that are given. And these types of trust could be revocable and irrevocable. When the trust is revocable, the IRS in the United States considers that there is no trust. So it's a disregarded entity trust. It means that the owner of the trust will be the one responsible for filing taxes and all that, like it is for himself. So the trust for the IRS doesn't exist. It will be executable, or it will be executed when the individual dies. Then the trust takes over if all the assets of the individual are in the trust. That is not the case for an offshore trust. Offshore trusts, they are in the Constitution. For an offshore trust, the ones that I have seen mostly are for holding of assets. So if I own shares and I don't want to open a trust in the United States or in Europe, I go to an offshore entity. Could be Panama, could be Cook's Islands in close to New Zealand, or New Zealand, Australia, or it could be in an offshore jurisdiction here in the Caribbean, like Nevis, or in Cayman Island. I say Nevis. Nevis is a better jurisdiction for trust. So if I go there and I open the trust, the objective that I open that kind of trust, an offshore trust, will be to transfer my assets, and the trust holds the assets for asset protection. So offshore trust, there are not too many types, like I want to donate to this institution, or I want to do that. Offshore trusts are not very much used for that. I've seen trusts like that they open, there is a foundation in Panama, for example, there is a trust in Panama, and then the trust owns the shares of the companies in Latin America, and the trust pays when the trust pays dividend, yeah, pays or donates the part of the income from the companies to the foundations in Panama. I've seen that combination to between companies in Latin America, a trust in Panama, and a foundation in Panama as well. Or it can also be that the assets that the shares are given to the foundations in Panama, and the foundation in Panama is the beneficiary from the trust. That also works. But that is an offshore structure, and it's very well used by many Latin American business owners. That they open a company in Panama, in Panama, or they open a trust in Panama, or they open some foundations in Panama with those objectives. In the United States, it's a little different. Offshore entities, there is no revocable or irrevocable trust. There's only one figure. Once you open a trust in an offshore entity, it is a trust and cannot be revoked unless you go to the court and then you want to close the trust. But there is no legislation that if you report to the offshore jurisdiction, there's no disclassification of disregarded trust, like a trust that is separate from you or a trust that is not separate from you. That doesn't exist offshore. That only exists here in the US. So in offshore jurisdiction, there is only one type of trust, a trust. That's it. In the United States, there's this classification of disregarded, a disregarded trust. When a trust is disregarded or irrevocable trust, a revocable trust, it means that the trust doesn't exist for the IRS. It exists only for the courts. And you are responsible for all the taxes that the income or the assets are producing. So the asset that could be these shares, could be property, could be royalty, all the income, licenses that produce royalty, all these assets that produce income, and that income is earned to the trust, because the trust now is the owner of all these assets. For the IRS, if that trust is revocable, it doesn't exist. You pay the taxes, even though you have a trust. When the trust is done irrevocable, meaning that there's no way to go back, then the trust pays taxes, and you are relieved of all those taxes. This type of instruments is very well used by the rich and famous, with the objective of discharge the responsibilities of taxes and giving it to the trust as one thing. And second, to protect the assets that they hold from, say, frivolous claims or from frivolous lawsuits that they may have because they are rich and famous.
Understood. Third question. What's the difference between a foundation and a trust when paying taxes in the USA?
In the case of a foundation, it's a non-profit organization. And if there is this classification, 501c3, 501c3 is a classification for non-profit organizations that are exempt from taxes, the foundation becomes tax exempt. It means that all the income that the foundation receives is non-taxable. But, and this is the big but, the foundation and the non-profit organization must present a plan for expanding the assets according to the program that the foundation and the non-profit organization has created when it was filed. I can only create a 501c3 through a program that I am going to reveal to the IRS when I am creating the 501c3, when I'm creating the foundation. I have to tell the IRS what is my intention when I create this, how I'm going to distribute the asset. First of all, the income, the donation, how much I expect to receive in donations. One. Second, how I'm gonna use, how I'm gonna use or expend those donations. That I have to tell the IRS from inception when I open my foundation. So according to that, when the foundation receives the donations, I have to spend it in the programs that I created when I established the foundation. That's the basis of a 501c3 foundation. It could be, for example, a church is a non-profit organization, But it is until the church applies for the IRS recognition as a nonprofit, tax exempt, that the donations that I receive as a church are tax deductible for the donors. It's until I apply for the 501c3 exemption with the IRS that my donors will be able to deduct the donations that they gave me in their tax return. There are churches that they don't have a 501c3. They are not obligated to report to the IRS because a church doesn't work. A church receives donations, and then with those donations pays for the rent of the place where people meet, people who work at that place, and so on. But in the case of 501c3 or a tax exempt foundation of tax exempt organization, it is required for that to get that certification to apply to the IRS and get the approval from the IRS. That is a foundation in the United States. There are foundations also in Panama and in other offshore jurisdictions. So the objective of those foundations basically is to apply the donation that they receive according to the plan that they have created. It's the same concept. Only the offshore foundations do not report to the IRS. They report to no one because no one is controlling the foreign foundation. So foreign offshore foundations, for example, they don't have any obligation to report. Therefore, they are able to accumulate the income that they receive from their donors. That doesn't happen here in the United States. If you have a nonprofit in the USA, you receive donations, you are supposed to spend the donations, not to keep them, because if you keep them, it's not a nonprofit. You will be the tax exempt will be taken back, and all those donations will be taxable. So you have to spend the money. In the U.S., the nonprofit cannot accumulate the money forever. It has to spend. Outside of the U.S., in offshore foundations, things are different. There can be an accumulation of income, and there's no problem with that accumulation because no one is requiring the spend of that. But many times, offshore foundations are not used to accumulate income. They are not to accumulate donations. They are used to receive, for example, shares or receive assets from Latin American companies or from any company from any part of the world, any country, and to keep those assets or the title of those assets with them. That's basically what foundations do in other countries. For example, there are foundations in offshore foundations that they receive funds from foreign companies, and those funds are either kept with them or they distribute those funds to other nonprofit organizations in Latin America. That we also seen that in offshore structures. But here in the U.S., that doesn't exist. If you receive income, you are supposed to spend that income in the programs that you reveal to the IRS, that you gave the IRS when you opened the nonprofit organization.
Understood. When and how should the trust be declared?
If the trust is open it all depends if the person who is creating the trust is a U.S. citizen. If there is a U.S. citizenship for the person who is creating the trust, then the person will be obligated to report the trust, either receiving distributions or not, either income or no income. If the person is a beneficiary of the trust, and he or she is a U.S. citizen, the person needs to declare that to the U.S. government, especially because if there is a distribution of income and that income is not reported, there is a tax evasion. There's tax evasion, and because of that, the IRS has in the USA for US citizens has required that any beneficiary of a foreign trust needs the obligation to report to the trust.
Get it.
When
What?
the trust, wait, when the trust is not in the United States, there is no obligation to report to anything.
Oh, okay, understood. What
And
are the benefits?
Yeah, but if the provider, the person is not U.S. citizen,
Right.
if there is a trust in the U.S. or a trust or an offshore trust, and the person is U.S., then the person is obligated to report the trust if the trust is offshore. If the trust is in the U.S., then there is no obligation to report unless there is a distribution. If the person is not U.S. citizen and the trust is in the U.S. or offshore, there is no obligation to report.
Got it. What are the benefits of a trust?
The benefit of a trust is first, asset protection, and second, the ability to transfer, to give instructions when you are alive, and when you are not here anymore, your instruction will be fulfilled through the trust. Now, I have heard many times that attorneys in real estate recommend that a trust is needed to complete the offshore to complete the protection, the asset protection. I will say no, unless there is an intention to transfer the asset to the next generation. Because when there is a trust, the trust in the US pays taxes at 35%. So it's high, the taxation for the income that the taxes that the trust receives in the United States. It's a high rate, 35%. And if that is the case, the best to, let's say, to organize your tax structure, your tax strategy, or more than that, your asset protection strategy. If you are an offshore investor, you buy a property in the United States and you are a US citizen, you buy a property in the United States and you open an LLC, has to be at least with 2 members to get the limited liability protection. Then this LLC, you open a management company that is an S corporation, and then they say you have to put the management, the assets of the title of the management company or the shares of the management company into an asset, into a trust. I would say that better is to open a land trust. And we have clients that instead of open a regular trust, they open a land trust, and a good real estate attorney will be able to help you doing that. You open a land trust, and if you have multiple properties within one real estate entity, the land trust will help you to, let's say, to fraction the risk. So if anything happens in that with one property in the LLC, the other properties will not be affected, but you have to have a good trust indenture or a trust agreement that stipulates that, and this is how a land trust is created. Basically, that's one of the let's say one of the benefit of the trust, that the ability to protect your assets. This is for trust in the United States. When the trusts are offshore, they are used not only for asset protection but also for secrecy, for the protection of the identity or identity protection of the asset, of the owner of the asset. Because if someone wants to, let's say, that obtain information from a trust, and there was a case, for example, of a widow that the children of the widow wanted to break the trust before she dies, and the trust was in Nevis, and even though they went to Nevis and they hired an attorney, the attorney posted a $25,000 bond for knowing about the trust. The court did not open the trust and did not reveal what were the assets that had been transferred to the trust during the time of the life of the husband of the lady, of the widow. So it's proof that Nevis is a good legislation for the trust. The courts are very strong The laws are very strong. The courts are very respectful in terms of when to open the trust, and trusts are never open, have not been ever open in Neves.
Understood. Last question. What is a corresponding account?
Well, a corresponding account is something different from a trust. A corresponding account is a trust that is an account that is used for dealing with money from third parties. For example, I want to open a Western Union type of business, and my clients here in the U.S. receive, or any other country, I receive the funds from the clients in my country, from my clients in my country, and then I have to transfer that money to whoever they told me to transfer to. And for that, I need a corresponding account to transfer that money, to receive that money, deposit that money, and then transfer that money to any other bank that is giving the service in that country, in the country of destiny, for the money that I have received. So it's basically, if I am a type of Western Western Union business, or if I am an offshore bank, for example, if I am an offshore bank, I also need a corresponding account with the objective of serving my clients, receiving wire transfer from their accounts in other banks, and deposit that money into my corresponding account, and later on transfer that money to whoever they say. This is when the corresponding account is useful. It's useful when I am an offshore bank and I need to serve my client.
Understood. That is all of our questions for today. Thank you, Fulton, for your time and also information. If you have any more questions, you can send them to our email or social media. We do have a Facebook private group. We'll put the link down below, and we'll see you on the next video.
Thank you.